The economy is falling apart. Credit card debt is increased the most in 20 years. Obviously, people are having a hard time making ends meet, so they got to go into debt. Oh my goodness. Oh, it's over. It's over. It's been a good run, but it's over. Let's go into this a little bit. I actually want to show you something here real quick. This is from CNBC. Credit card balances jump 13%, highest leap in over 20 years as inflation outpaces growth. Now, I came across this article from a conservative website I follow, and actually it ticks me off because as much as I can't stand Sniffy Joe, I can we have some perspective here, my friends? I hate this crap. I hate it. And I'm going to show you why, and we're going to dive into a little bit deeper. Because we're going to see, despite seeing real gains in wages, Americans, hold on a second, right here, must contend with higher cost of living, which is growing at the highest annual pace in more than 4 decades. Well, not if you have your house paid off, but be that as it may. To bridge the gap, consumers are relying on credit cards to get by, which has helped propel total credit card debt to $890 billion. Oh my goodness, the fastest pace in 20 years. Overall, credit card balances rose 13% in Q2 2022. Even so, balances remain slightly below their pre-pandemic levels after sharp declines in the first year of the pandemic. Interesting, huh? Even so, balances will remain slightly below their pre-pandemic levels. Interesting. And now we're only going to 2019. Why are we even... That's interesting, huh? All right, so that's interesting. So balances remain low before the pandemic. All right, so then we're going to go over here and we're going to say household debt. U.S. households took on more debt in the second quarter, pushing total household debt up to up to 16 trillion. 16 trillion is a household debt. 2 trillion higher than they were before the pandemic. Oh my goodness, the household debt is up to 16 trillion. It pushed up to 312 billion. Oh my goodness. Snapshot. Mortgage balances account for a large chunk of the increase. Got a frog in my throat. Rising 207 billion to 11.4 trillion at the end of June. Credit card balances also rose, which we talked about that. But it's still lower than what it was basically 3 years ago, whatever. Elsewhere, auto loans balances rose by 33 billion, while student loans were roughly unchanged at 1.6. All right, so the second quarter 2022 showed robust increases in mortgage, auto loan, and credit card balance, driven in large part by rising prices, especially when the household debt, i.e. mortgages, account for the large chunk of the increase. Household balance sheets appear to be strong, though, but we're seeing a rising delinquency among subprime and low-income borrowers with rates approaching pre-pandemic levels. Yeah, pre-pandemic. So now we're back to saying, well, this is bad because the delinquencies among subprime and low-income borrowers are up relative to where they were before we went to this insane recession. All right, or insane, just so freaking stupid. So I want to show you something here. This is total net worth of the U.S. Total net worth of U.S. households. All right. So we got in millions of dollars. I don't even know what that is. 141 million. So is that 140 trillion? I think it's 140 trillion dollars of net worth. I wish they could do it in trillions. I can't figure this out. Anyway, there you go. So we have 100. This is in millions of dollars. 141 million dollars is a net worth. Net worth is assets minus liabilities of the United States. All right, look at that increase. Shoops. Yeah, that's a little bit of a decrease, I grant you, but look at that. $141 trillion is, it's got to be trillion, is a net worth. If we go back to this thing right here, what do we say? U.S. debt is now at $16 trillion. What does that show you? That we have a hell of a lot huge net worth relative to debt. Now you could say, but yeah, this is because Jeff Bezos and everybody. This isn't the average Joe. So let's take a look at the average Joe, shall we? This is net worth by the bottom 50% of the population. Net worth by the bottom. Look, right there in 2011, it was breaching on, coming down to almost nothing in 2011. 184
I guess millions of dollars. I can't even read that. I don't know what that means. 180. This is in millions of dollars. So is that 184 million of millions of dollars? So I guess that's what 184 trillion. Is that what that is? Whatever it is. Look at it now. That can't be trillion. You can figure it out. It's above zero. So remember, net worth consists of assets minus liabilities. Assets minus total liabilities. When I'm doing financial plans and people say, "What's your fee?" I say, "It's your net worth is over $1 million. My fee is $2,500. If your net worth is under $1 million, my fee is $1,250." And they say, "Well, my assets, my investments are $800,000." Well, that's part of your net worth. Your net worth is assets minus liabilities. Your house is part of your assets. And I don't really care about your car and your baseball card collection, your firearm collection. It's mostly real estate investments. But anyway, net worth is all assets minus liabilities. That's what net worth is. And you can see here, look at that. The bottom, I don't know what this is. What is that? I had no idea. $3.9 million. I don't know what that is. But anyway, you can see that's your net worth. That's assets minus liabilities. I'm going to assume that's $3 trillion, but I don't know. Anyway, the net worth of the bottom 50% of households in the United States is significantly in the positive because this already takes out liabilities. That's net worth. It takes out liabilities. But look at that growth, man. It went from, I guess that's 184. I wish I could get these numbers right. I don't know them. I wonder if there's a way to reduce the zeros to right there. I can't even do that number in my head in terms of the increase. So let's go to edit graph to log this because you always want to log it because it doesn't look as dramatic because percentages are all that matter. Actually, that actually looks more dramatic. Look at that. Jeez, man. So basically, and this is about where we should be. The crash of 2007, 8, 9, it went all the way to 2012, basically. And if you look at a graph, it should be, we're basically, other than this, we're basically spot on where we should have been from 1990. If we just kind of, and I'm not going to, we should be probably right about there, I guess. And we're a little bit underneath that, but we're basically spot on where we should be from 30 years ago. If you just kind of do a linear, let's do I don't have a ruler here, do I? Oh, man. So let me just do this. You guys can't, I don't think you can't see what I'm doing. So it's kind of like that. Yeah, we're basically we should be right about there. I use my food stamp thing to get a linear thing. Isn't that interesting? Actually, that's crazy. This log actually makes it look even more dramatic. That's nuts. Usually it's the other way around. It doesn't make it look as dramatic. Yeah, it's the whole point is, man. Yes. We're going back to a regular economy, which is some people are over leveraged and they're going to be, they're hurting. It sucks. This happens. It happens in communism, happens in socialism, happens in somewhat quasi-fascist capitalism. It happens. What do you do about it? Nothing. I mean, the best thing you do is pay off your debt. That's the best thing you can do. Anyway, when you hear these horror stories, just freaking break the wrist and walk away. Break the wrist and walk away. All right, love your thoughts. We'll see ya.